Today's hot topics are going to be inflation, Bank of England base rate and mortgage rates. As some of you may or may not be aware, the Bank of England had predicted for inflation to fall sharply this summer. Sadly, this hasn't happened and the Bank of England had to change its forecast accordingly. But why is inflation so high? One of the main reasons was Russia's invasion of Ukraine, which led to very sharp increase in gas prices. We also have to keep in mind the impact of COVID. This saw all of us buying more goods. However, this then created a supply and demand issue, which led to higher prices for goods, particularly those that were imported from abroad. The UK has a lot of job vacancies, which means that employers are having to offer higher than average wages to attract employees. And we can't ignore a number of large institutions that have been offered an above inflation pay rise this year. Sadly, this does impact on inflation. By having more disposable income means inflation is not falling as predicted. This is why the Bank of England has been slowly increasing the base rates. And by increasing the base rate, it makes it more expensive for people to borrow. And this should encourage them to save more, which means that we spend less on goods and services, and prices will still rise, but at a much slower pace compared to what we've seen in the past. So how does this impact on mortgage rates? Now, most banks borrow money for the fixed rate mortgages via something called the swaps market. Now, broadly speaking, the swaps market floats in and around in line with the Bank of England base rate. Now, with inflation not being under control and looking at all the current data, it would suggest now that the Bank of England will be increasing the base rate later on this month, based on what we're seeing happening in the swaps market. Now, this simply means that it costs the banks more money to fund your mortgage, and sadly, that cost has to be passed on to the customer. Because the swaps rate market changes daily, it has meant that mortgage lenders have had to reprice their mortgage products to reflect these increases that we've seen happening over the last couple of weeks. So what can we do? Now, we know 1 in 3 people in the UK have a mortgage and will no doubt be concerned. But what we are still seeing is properties coming to the market and customers still taking out mortgages. Now, those that are buying or remortgaging this year are being a little bit more cautious. And what's really important is they're getting good advice. It allows customers to be provided with a solution that's not only affordable today, but affordable for the future, whilst ensuring that they're fully protected should the unforeseen happen. Now, stability will return as the market is supported by good employment and better than expected salaries. And the latest data suggests that inflation will fall by the end of this year to around 5%. And we should then see to start mortgage rates falling again in line as they start to stabilise. And again, I'd expect this to be slow as we've seen in the past. Look forward to seeing you all next week.